Financing your investment and budgeting.
So we're going to do a lot of math today because math really matters. It's crucial to understand the distinctions in interest rates, investment loans, and what we're really doing and why they are riskier. So I'm going to just basically start this off by saying banks understand that your loan for your home you're going to live in is a little bit more secure because you're going to do everything in your power to keep the home that you live in. Now, they also understand that if you're buying a rental property, this is a little less secure because if push comes to shove and you've lost everything, the first thing you're going to try to save is your own lifeboat, your own home, not your rental property. So they understand that. So your money is going to be a little bit more, it's going to be a higher risk for the bank. So we have to understand that when we're looking at all of these things and understanding risk takes reward. And we have to understand that there is a little bit more risk in order for banks to do this for you.
Do you want it to make an example too?
No, tell me what an investment property loan is.
Exactly. The investment property loan?
Mm-hmm.
Okay.
What is it? Basically, this is what we were saying, that the loan itself is going to have a higher interest rate compared to owner occupancy because those loans are riskier. And I gave you the because why it's riskier. Now I'm giving you the definition. Do you want to give an example or through today?
Yeah, can you make an example?
Okay, so say you're looking at a cookie cutter neighborhood. There's two identical homes that one's going to be lived in and one's going to be rented out. The owner occupied might have 30-year fixed term. At the current filming of this video, maybe they have 6.5% or 6.3%. And the investor who bought the other one that is exactly the same is going to have a 7.5 or an 8, again at the filming of this video. And this is going to directly affect how much each are paying monthly, how much profitability is in that investment portfolio as well. So we can't look at it the same because apples and apples, even though the house is the same, the payment is not going to be the same. So we have to look at our risk this way.
Exactly. The next thing that we wanted to talk really is about understanding the power of the leverage.
Before we do that, can we do our introduction? Let's hit it. Hi, it's Alan Victoria. Welcome to our channel and podcast.
And if this is your first time in our podcast and YouTube channel, make sure you subscribe and get notified.
Also, you call text all the time, 252-327-3357. We love talking to you. Don't be shy. Also, grab our buyer's guide and seller's guide in the description below. Now tell me about leverage.
Now, in real estate investing, leverage is really using a various financial instruments or borrowed capital to increase a potential return on investment, or ROI, is calculated by dividing the total investment cost by the amount of the actual cash that you invested in real estate. Now, let's make an example. If you purchase, for example, $200,000 property and you use 20% down payment, which is $40,000, really $40,000, if you subtract it from 200, you have $160,000, which is the ratio of leverage 5-to-1 that you need to finance it. And if the property value, for example, increased to $220,000 in a year or two, your actual equity would be increased to $40,000 from $40,000 to $60,000 because you put already initial investment of $40,000. Now you have $60,000, which is really a 50% return on the invested capitals, which is higher than 10% increase in your property values.
Okay, so the next thing I'm going to talk about is your CapEx, your capital expenditure reserves. You have to budget for CapEx, I would say, which is, it's really basically a sophisticated way to plan for future repairs. And you want to improve this rental property. This is not the same as minor repairs. We're not talking about patching the wall. We're not talking about changing the light bulb. We're not talking about the carpet. We're talking about substantial upgrades and replacements that's going to extend the life of that property. Maybe it's a new roof. Maybe it's a new HVAC system. But you want to be able to plan for this. So basically, if you have a $200,000 worth of rental property, you should allocate 1% annually, which is about $2,000 a year, in order to really say, we're going to make sure that these systems continue to go. Because we don't want to affect our cash flow. So we have to kind of take this into consideration before we even buy the first home.
Exactly. And then my wife already gave you an example. The next thing that we wanted to talk about is utilizing debt service coverage ratio, which is as known as DSCR, which is a measure of the cash flow available to pay current debt obligation. And this calculation used by your lenders and also useful for real estate investment when they are assessing a property viability And this formula is net operating income divided by total debt services, which is really your mortgage.
Basically, you want to keep your debt in check. That's I'm going to sum it up. That you have to keep your debt in check. You want to give me an example? Or do you want me to do it?
Exactly. Let's say you have a rental that you purchase and you get $1,200 per month as a rent, which brings to gross income times 12 months is going to be $14,400. And let's say your annual debt, including your principal, interest, or any financing cost, is going to be $12,000. And now, as we said, the formula is going to be net operating income divided by debt services. Now, the operating was 14,000 divided by 14,400 divided by 12,000 is going to give you 1.2%.
And this is a good coverage, so you're lower the risk because you are being able to pay that lender off.
Exactly.
The next thing is going to be the tax implications and depreciation. Many investors are going to buy investment property for this exact purpose. They want the depreciation on their taxes. So we're talking about non-cash expenses. Basically, the tax law allows for a residential building to depreciate over a 27.5% schedule. So if you purchase a property of $275,000, excluding the land, which is typically 20%, you can depreciate $250,000 on that investment, which will allow you for an annual of about $9,090 on every single year on that property on your taxes, which is why many people buy these properties.
Now, if you want to go to the advanced budgeting, that you need to follow the 50% and 1% rule. And what is this? Basically, a real estate investor that they are savvy, they're using this 50% and 1% rule to be a guideline for their making decision.
It's not a golden rule. You don't have to follow these rules. These are good rules, not must-follow rules.
Exactly. This 50% rule really states that roughly half of your rental income will go toward your expenses, not including your mortgages. And the 1% rule suggests that property monthly rent should be at least 1% of the purchase price, which brings us to example. What is the example?
Basically, if you bought a property at $200,000 with the 1% rule, you should be able to rent it out for $2,000 a month. And then applying the 50% rule, if you receive $2,000, $1,000 should go towards non-mortgage expenses. Again, with 8.5%, 8% interest at the filming of this video, this is a little rule that's extreme. However, if you can get to these rules, this is great. So if you can take these concepts, these terms, and really understand your financial implications on your investment to a really sophisticated way, you're going to plan for your future and make a really informed decision based on math. And that is always a good thing. So we said we were starting with math.
And also, don't forget to contact Alan Victoria Pinder, real estate agent professionals in Pitt County, North Carolina, Greenville and Winterville. And we'd love to help you. And also watch this video and also seeing you next time with the new videos.